Welcome, Forex Essentials, a beginner's guide to Forex trading, prepared by Cruise Institute. Fundamental Analysis. Introduction to Fundamental Analysis. Fundamental analysis is a method of evaluating the value of a financial asset, such as a Forex pair, by examining economic and financial factors that may impact its price over time. These factors can include macroeconomic data such as the gross domestic product, inflation, interest rates, as well as consumer confidence and company specific data such as earnings report and corporate news. By understanding the fundamental factors that influence the forex market, traders can more accurately anticipate future trends and movements in currency pairs. Fundamental analysis is particularly helpful for long-term traders who are looking to make trades based on a macro view of the economy or a particular currency. However, short-term traders can also use fundamental analysis to inform their trading strategies, especially when major economic events or data releases are scheduled. Economic indicators. These are key components of fundamental analysis in forex trading. These indicators are statistics to provide information about the health and performance of a country's economy. Traders use these kind of indicators to identify trends, determine potential trading opportunities, and make informed trading decisions about forex traders or trades. Common economic indicators that forex traders use to inform their trading decisions include, as mentioned, GDP, which is one of the most important economic indicators as it provides information on a country's overall economic performance. It measures the total value of goods and services produced by a country in a specific given period of time, typically quarterly or annually. We also have what we call a consumer price index, CPI, which measures the change in the price of goods and services purchased by consumers over time. It is used to measure inflation or even deflation. We also have economic data, or rather, employment data. This includes a number of people currently employed, the unemployment rate, and the average hourly earnings. This information can provide insight into the overall health of an economy. We also have central bank interest rates. These interest rates set by a country's central bank play a crucial role in forex trading. Interest rates can impact a currency's exchange rate as well as their direct investment in a country. We have what we also call a trade balance. This measures the difference between a country's imports as well as exports. A positive trade balance indicates that a country is exporting more than it is importing, which can be viewed as a healthy or a positive sign for the economy. These are just a few examples of numerous economic indicators that forex traders can utilize to make informed decisions about their trades. Understanding the impact of economic indicators on forex trading is essential to becoming a successful forex trader. We also have what we call news events. These are important aspects of fundamental analysis in forex trading, as news events can range from major political announcements to economic data releases, and this can have a significant impact on currency values. So, traders use news events as a way to stay informed about market changes and potential trading opportunities. Some of the most important news events for forex traders that we need to watch out for are central bank announcements. These play a crucial role in the FX environment, as the announcements can have an immediate impact on currency values. Traders keep a close eye on announcements related to interest rates, the monetary policy, as well as an overall economic outlook. We also have economic data releases, which include your CPI, employment data, and your GDP levels. This can have a significant impact on forex prices. Traders use economic calendars to stay updated on upcoming data releases and they assess their potential impact on currency values. We also have geopolitical events. These can include political turmoil in certain nations, could be elections, and international conflicts, which can have a major impact on currency values. Traders need to pay close attention to international news to assess potential risks to the market and adjust their trading strategies accordingly. We also have corporate news. These are news related to major corporations, which can impact currency values, especially if the company is a major player in the global market. For instance, if there's a news of a merger or acquisition, this can impact a currency value as it affects an entire industry or a market sector. So it is important as traders to stay informed about news events and their potential impact on forex prices. Understanding news events impacts how news events impact the markets can help traders identify potential trading opportunities as well as make informed decisions moving forward. We also have central bank policies. These play a crucial part in the FX community as central banks play a powerful role in controlling the supply of money in an economy as well as the interest rates they put out. Understanding central bank policies is an essential aspect of fundamental analysis for forex traders. The following are the most common central bank policies that traders need to pay attention to. We have the monetary policy. Central banks use this to control the supply of money in the economy. So, by adjusting the money supply, central banks can influence inflation and economic growth. Forex traders pay close attention to monetary policy announcements as they can indicate changes in the value of a currency. We also have interest rates. These are also set by the central banks and they have a significant impact on the value of a currency. When central banks raise interest rates, this can attract foreign investment, leading to a stronger currency. By contrast, lower interest rates can also lead to a weak currency. Central bank policies. We still have quantitative easing. This is a policy that involves increasing the money supply by purchasing securities. This can stimulate economic growth, but it can also lead to inflation. As forex traders, we need to monitor QE policies as they can affect the value of a currency. Lastly, we have currency interventions. This is when central banks intervene in the forex market by buying or selling their own currency to influence its value. Forex traders need to watch out for such interventions as they can create short term volatility. As forex traders, we rely on central bank policy announcements and indicators to inform our trading decisions. The policies themselves, as well as the indicators used to measure their impact, are critical to understanding how the forex market functions in its dynamics. In moving on fundamental analysis, we have what we call market sentiment. This refers to the overall feeling or attitude among traders and investors towards a particular market or asset. It is an important aspect of forex trading as it can affect the supply and demand of currencies and ultimately impact their value. We have two types of market sentiments. We have the bullish, which simply means traders are optimistic about the prospects of the market or the asset, the currency pair. And then we also have a bearish market sentiment, which means traders are pessimistic and expect the market or the asset to decline in value. Forex traders use various indicators to gauge market sentiment. We have what we call news and events. Major news events such as economic data, releases, political announcements have and can impact market sentiment. Positive news. Positive news can lead to a bullish sentiment, while negative news can lead to a bearish sentiment. Another way traders can use to gauge market sentiment is that traders can analyze charts and patterns to identify trends and momentum in the market using technical analysis. This can indicate a bullish or a bearish sentiment. We also have what we call sentiment indicators. So some forex trading platforms offer sentiment indicators that measure the number of traders who are long versus who are short on a particular currency. This can give traders an idea of the overall market sentiment. We also have the tools of social media. So some traders use social media platforms to gauge sentiment and among retail traders who can influence the market through their collective actions. Thank you.